This is Q4FY24 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanket Chedda from DAM Capital Advisors. Thank you, and over to you, sir.
Yeah, hi. Very good afternoon to all of you. A warm welcome to the call to discuss Mass Financial's Q4 results. We have with us entire senior management on the call today. Mr. Kamlesh Gandhi, who is a chairman and managing director. Ms. Darshana Pandya, who is director and CEO. Mr. Ankit Jain, who is a CFO, and other senior management team as well. So without further ado, I'll hand the call over to Mr. Kamlesh Gandhi for their opening remarks, which we will follow up by question and answers. Over to you, sir.
Thank you, Sanket. Thank you, Sanket. And good afternoon to everyone. Happy to connect to all of you once again to discuss the 116th quarter of our consistent financial performance. So, friends, 116th quarter is a very long time, and happy to share with you that we have been in a position to perform very consistently over all these years, and God willing will continue to do the same in the future also. Just to give you the information on few of the important milestones that we crossed in this year. So while you can never be satisfied, but we are quite happy to cross certain milestones. Namely, as shared with all of you, we crossed a very important milestone of crossing 10,000 crores last year. We got upgraded to, we got our rating upgraded to AA minus from CARE. As such, it was little overdue. And another important milestone, we crossed 250 crores in consolidated profit after tax. So these are few of the important milestones we crossed, which will lay a very strong foundation for the decade. As all of you know that when we meet, I always share with all of you that at Mass, for us, decade is a medium-term view, and we never take a short-term view, and hence we are in a position to concentrate on the fundamentals and have demonstrated this robust financial performance over all these years. While my colleagues will take you through the detailing in number, if I just take you through few of the strategic things for this quarter, is that the growth translates to a 26% in AUM and 23.41 in PAT in consolidated basis. On a standalone basis, also we grew at around close to 23% in AUM and PAT. As far as our housing finance company is concerned, and I think all of you might remember that we were I've been giving the guidance that this company is now on cusp of delivering robust results. I'm very happy to share that we could grow this quarter at a very robust 44% this quarter. Having said that, we got good opportunity to grow at 44% this quarter, but the guidance remains in the range of 30 to 35% growth, which we'll try to surpass. So from the housing front also, we could register a very robust growth on AUM profitability, very importantly on the quality of the assets. As I talk to you, our quality of asset in our parent company is a gross stage 3 assets of around 1.51%, holding on a buffer provisioning of another 0.24%. In our housing finance company also, the quality of asset is very benign. That is the net stage 3 of close to 0.6%. Capital adequacy at a very comfortable or at a very fundamentally strong level of close to 24% in capital adequacy, with close to 21% in Tier 1 and the rest in Tier 2. Housing finance company also with a very robust capital adequacy of more than 38%, where we get the advantage of a lower risk weightage of being in the affordable space. The other way to look at it is the leverage. Leverage remains at a very comfortable leverage of around 4 in our parent company, and the same in the case less than 4 in our housing finance company. So all in all, the development for the entire year has been in sync with our understanding of all these years of running the business, of making a fundamentally strong business. Where if I talk about ROEs at around, on a yearly basis, at around 16.5%. The last quarter registered a ROE of 16.98%. So we have been advocating that we are a company which will endeavor to grow anywhere between 20 to 25%, maintain ROEs in the range of 15 to 17%, a very strong self-propelling capital model. Having said that, we have an enabling resolution to raise capital whenever we require. As I shared with you last time, we have an enabling resolution of 700 crores. I met few investors in the last quarter. We'll be meeting few investors this quarter also. But we would take our own time and we'll decide and select the right set of investors who can align with our objective of consistent performance, and in our belief that consistency and steadiness is the best way to reach your destination. In terms of our distribution, I think we have consolidated on our direct distribution substantially. Our RSA distribution has also consolidated. While, as I've shared a number of times, that our direct distribution will grow at a faster pace as compared to our indirect distribution, and hence this, as I talked to you, we are at around 68-32 ratio in favor of our direct distribution. Going forward, we see that settling anywhere between 70 to 75 in favor of our direct distribution. This is in line with the guidance we have been giving since few quarters. I'm very happy to share that we could achieve those guidance. In terms of the assets we serve, we've still driven predominantly MSME funded, around 80% of our business coming from MSME, and the rest coming from wheels, and less than 6% coming from our SPL business. Housing contributes a modest 6% currently, but going forward with the type of growth trajectory we are anticipating, it should also contribute very meaningfully to the overall assets of the company. On the liability side, as I shared and Ankit will share in detail, we are well capitalized, and as usual, we have a very strong debt line. Almost we have tied up for till Q1 or say to an extent for Q2 also, as I talked to you. And with rating upgrade, we'll have more opportunities to tap more avenues, and also in the medium term reduce our cost of borrowing. On operations, we continue to embrace technology adequately. We are a company which is having our own technology team in-house. We have one of the most strongest LMS as far as LMS is concerned. We have developed LOS for all our systems, and we are embarking on core banking also. We have set up a team at Mass to look after core banking, and within few quarters, I think we'll be in a position to share the progress on that also. And our team remains a strong team of 3,700 people, with a big team of collectors succeeding and failing together, has held us in a good state with more than 550 people now with us for more than 5 years. And obviously, the co-owners of this company, the core team, which has been with company with ranging from 15 to 25 years. So that forms a very formidable second line of action, second line of team, with Dhwani also from the promoters group quite active, and he will be completing his decade this July. He joined in 2014. So with this remarks, rather than taking much of your time on this commentary, which many of you know, I will hand over to my colleague Darshana. She will take you through detail in numbers, and then to Ankit, and then we will be open for Q&A. Thank you.
Thank you, sir. Good afternoon, everyone. So we are very happy to share that in the last quarter we crossed the very important milestone of 10,000 crore on consolidated basis, and this quarter we have crossed this milestone on standalone basis. So if we look at the consolidated numbers. Our consolidated AUM as on March 24 is now 10,722 crore as compared to 8,506 crore last year, and PAT for the year is 254 crore as compared to 205 crore, which is 26% growth in AUM and 23.37% growth in PAT. If we look at the standalone numbers, starting with the breakup of the AUM, our MSME portfolio is contributing 80%. 4,385 crore is a micro enterprise loan. SME loan is 3,734 crore. Wheels loans are contributing around 14%. 670 crore is two-wheeler loans and 748 crore is commercial vehicle loans. And salaried personal loan is 588 crore, which is 5.8% of the total AUM. That is 25.12% growth in standalone AUM. If we look at the total income on quarterly basis, it says it is now 329 crore. So last year it was 268 crore. This is 23.04% increase in total income on quarterly basis. Profit before tax has increased by 29.37% on quarterly basis. Last quarter, Q4/23, it was 70 crore 41 lakhs, and this Q4 is 91 crore. Profit after tax has increased by 22.50% from 55.55 crore to 68 crore this quarter. If we look at the yearly number and on annual basis, total income has increased by 30.29% from 940 crore to 1,225 crore. Profit before tax has increased by 25.21% from 265 crore to 331 crore. And profit after tax has increased by 23.28% from 201 crore to 248 crore. So this is the financial numbers. If we look at the portfolio quality as shared by sir, our gross stage 3 is 2.25% and net stage 3 is 1.51%. In December quarter, it was 2.23% gross stage 3 and 1.48% net stage 3. Now coming to our housing finance performance. Now our portfolio in housing finance is 596 crores. That is 44.26% rise in AUM. Last year it was 413 crores. Total income has increased by 42.58% on quarterly basis from 12 crore 40 lakhs to 17 crore 68 lakhs. Profit before tax has increased by 54.21% from 1 crore 70 lakhs to 2 crore 62 lakhs. Profit after tax is 51.55% rise from 1 crore 37 lakhs to 2 crore 8 lakhs. And if we look at the annual numbers, increase in income is 42.75% from 43 crore 75 lakhs to 62 crore 46 lakhs. PAT has increased by 18.31% from 8 crore to 9 crore 58 lakhs. That was PBT, and PAT has increased by 19.48% from 6 crore 34 lakhs to 7 crore 58 lakhs. Here also the portfolio quality is very stable. The gross stage 3 asset is 0.90% and net stage 3 asset is 0.66%. In the last quarter, it was 0.81% gross stage 3 and 0.58% net stage 3. So this was about the performance in our housing finance company. Now I will request Ankit to brief you about the liability management.
Thank you, ma'am. Good afternoon all. To elaborate on the capital and liability management, the company through its efficient liability management was able to maintain an average liquidity of around 800 crore during the quarter and unutilized cash facility of rupees 575 crore. In addition, the company has sanction on hand to the tune of around 1100 crore which will fill up the requirement in the coming quarter. In the March quarter, company did around rupees 600 crore direct assignment transaction. The company further has around 1,000 crore sanction on hand, which will be utilized during the quarter and next year. The off-book portfolio is around 22% of the total AUM. We as a strategy aims to maintain around 20-25% of AUM as off-book through direct assignment and around 5 to 10% off-book as co-lending. The company has available cash facility of around 1,700 crore, out of which we maintain utilization level of 70 to 80%. That portion is kept as liquidity buffer. We raised around 890 crore term loan during the quarter with an average maturity of 3 to 5 years. This helps us to further strengthen the asset liability maturity pattern. We are strongly placed with respect to structural liquidity for the period ended 31st March, and thereby the liquidity is adequate and cash flow in all the liquidity bucket is positive. In terms of capital adequacy, the Tier 1 capital is 20.33% with a total capital adequacy of 24.05%. Our debt equity is around 4 times. In terms of cost of borrowing, the cost of borrowing for the quarter was 9.82%. The cost of borrowing for March quarter last year was 9.34%. But the better part is the cost of borrowing has remained stable if you compare with the last quarter. We expect cost of borrowing to be around this level in the coming quarter also. One achievement in terms of credit rating update, where the company long-term bank facility and NCD rating has been updated to AA- from here, from the A+. This upgrade in rating will help us our drive to diversify our resource mix and that too at a competitive pricing. Thank you. So now we are open for the Q&A round. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from Hardik Doshi from White Whale Partners. Please go ahead.
Yeah, hi. Thanks for taking my question. I wanted to just understand on the operating expenses side. The operating expenses had gone up as a percentage of AUM and as a percentage of NI in FY23 because we were investing more into branches, our people, and moving more of the sourcing through our distribution. But since then, it was kind of gradually trending down, but it seems like in the fourth quarter, it has again kind of gone back up on a year-on-year basis. Can you just maybe talk a bit about were there any particular investments or any one-offs here?
See, on cost of operations, as I've been sharing since long that the right way to look at it is maintaining our ROA. So the cost of operations, once we have our retail at around 70-75% in terms of percentage to AUM, will still increase. But at the same time, will be compensated by the yield what we will get, and hence our ROA will remain stable. If you see our ROA has been stable at around 2.80%, reflecting on the fact that the overall ROA dynamics has not been disturbed. And in terms of operations to NII and operations, the cost of operations to AUM, I still believe that we are at quite efficient stage, despite of the fact that many of the branches are yet to pick up on volumes. So once the branches picks up on volume, but at the same time, that efficiency to an extent will offset the opening of new branches, investment in technology and all. So we see this operational cost at this level or maybe little higher without affecting our ROAs.
Okay. And so I guess that is also the reason why our NIMs have gone up is related to this. NIMs and OPEX are both going up proportionally and ROAs are remaining stable.
Yeah. Yes.
Okay. The other question that I had was that we're continuing to grow our salary personal loans very strongly. How are you seeing the trends out there and the asset quality kind of indicators and any concerns? And second part of that is how much of this is being done through our partnerships with fintechs and how much is being done through our own distribution?
It will say salary personal loan is a new product, a very low base. We continue to maintain that this will be less than 10% of our total AUM going forward. We have maintained this even before the RBI raised the risk weightage for this particular unsecured personal loan. So we continue to maintain that it will be less than 10%. And in terms of our contribution from fintech, I think currently around 35 to 40% of the business in salary personal loan comes through our fintech partnership.
Sorry, 35 to 40% you mentioned?
Yeah.
Okay. And one last question is, you mentioned that we're looking to do the QIP and you had meetings last quarter, you will continue to have this quarter. But roughly, what is the timeline? Are we looking to do this QIP this quarter or is it open-ended?
It is absolutely open-ended because this is an exercise done very well in advance, not from the statutory requirement or not even from the gearing point of view. But in our next phase of growth, if you look at one link of chain at a time from 10 to 20,000 crores, we thought that some infusion of capital will further strengthen the balance sheet. So it is absolutely open-ended. We'll go on meeting investors quarter on quarter, look at the right set of valuations and the investors and take our decision.
Okay. Thank you.
Thank you. The next question is from Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Good evening and congrats on a great set of numbers.
Good evening.
Sir, my first question was pertaining to the credit rating upgrade, so congrats on that as well. So how do you see that, benefiting us on the COF side going ahead? And while there was this, risk weights increased by the RBI, while that doesn't impact us significantly, but with this, so point number one, that impact, and point number two, this benefit. How should we see, the COF going ahead because of these two reasons playing out?
So credit rating upgrade will definitely help us in the medium term. Majority of our loans are MCLR backed. So we will take this opportunity to renegotiate loans with all our lenders as and when there is a MCLR reset, including our negotiation on rates when we take a new borrowing. So that will kick in right from this quarter. But the overall impact on the cost of fund will take around a few quarters to be reflected in the balance sheet. In terms of credit squeeze, I think if you take it in the right perspective, RBI for companies like us who are mainly into MSME funding and growing cautiously are not against lending to companies like us. Even if you see banks, they are more than happy to lend to the companies who are very consistent in their approach, growing in a calibrated manner. And secondly, all the business what we do falls under the priority sector lending as far as the banks is concerned. So for us, there was no impact of any of the liquidity. As such, there was no liquidity squeeze or credit squeeze, but there was no impact on the RBI commentary from time to time on NBFC. Secondly, with our credit rating upgrade, we will look at diversification of resources. We might like to have more of capital market participation going forward, so as to decrease our dependence only on banks. So within few years, I think capital market, which is currently around 8 to 10%, can be anywhere between 15 to 20%, depending upon the overall market situation. But that will give us an opportunity to have multiple sources of funds.
Funding, right. Got it. So point number 2 was, I was looking at the number of NBFC tie-ups that we've added during this quarter. While we continue to add organic branches, so we've added some 8-9 branches. We have been proactive on adding NBFC partners as well. But if you look at the split of, this NBFC partner-driven book has come off or has been coming off. So is it fair to assume that our organic lending is at a relatively higher ticket size versus the NBFC partner-driven business?
Not at the higher ticket size. Our organic lending in absolute amount, as I shared, which is now 67-33 or 68-32,
right.
will be around 70 to 75% in the next few years. And we, as I have told number of times, that we have a fantastic experience with our NBFC lending partners too. So we don't mind adding on to new lending NBFC partners as we go forward, because in absolute terms that amount will increase. In relatively, the percentage is a shift from our direct retail to indirect retail, but in absolute terms the amount has to increase. So it is a cautious decision on the part of the company to have more and more partnership, to have limited exposure on each one of them, and have a well diversified asset base there also.
Got it. And so the organic business that we are building, or which we have already done commendable job on, so is the average ticket size relatively higher than the partner-driven business? Like, is it fair to assume that way?
Yeah. In certain products it is. Say for example, in products like MEL, in products like SME, it will be higher. In terms of two-wheeler and SRTO, it will be almost same.
Got it. And so if you look at last couple of quarters, the calculated yields have come off. So what explains that?
I think you have to go on a product-based basis, because average calculated yields will not always give the right picture because of so many variations and so many dynamics in that. But if we talk on an overall basis, I think on a conservative basis we maintain a NIM of 7% at an overall yield, combined yield of around close to 16%. And then we are left, after the credit cost and the operational cost, we are left with around 3.75 to 8% of profit before tax and 2.8 after tax.
Right. Got it. Sir, thank you so much for answering all my questions, and good luck for the next quarter.
Thank you.
Thank you. Next question is from the line of Subhranshu Mishra from Phillip Capital. Please go ahead.
Thank you for the opportunity. Good evening, Kamlesh sir, and congrats on good set of numbers. My first question is partly answered. Just want to understand the NBFC partner sourcing. We've always focused on sourcing MEL and two-wheelers, and I thought that we sourced most of our SME loans on our own. So just wanted that clarity as to how we have structured the NBFC partner sourcing now in each of the products. And if we are doing higher ticket sizes organically, what would be the credit risk and risk management on our own versus partner sourcing? That's my first. I'll come to the second after this one. Thanks.
So in terms of our NBFC partnership, I think they contribute very meaningfully as far as MEL is concerned, to the extent of say around 40 to 45%. In SME, they contribute anywhere around around 25 to 30%, and in two-wheeler and SRTO in line with our overall mix of anywhere between 25 to 30%. So, but for MEL, they more or less contribute equally. In terms of going on our organic growth and in terms of the risk management, as you know that we have been a company who have believed in growing very cautiously, putting the credit risk and the profitability before just the growth. So if you see our SME portfolio, whereby we have increased our ticket size to an average of 20 lakhs of rupees, the quality of the portfolio has been maintained in the most satisfactory manner. And as and when we increase our ticket size, that will be the endeavor to see to that how the credit quality is maintained, and then go on the growth part on those high ticket size. So that fundamental that fundamentals will be observed as far as the operations are concerned.
Understood, sir. And in terms of our borrowing mixture, we still have a significant portion of cash credit or overdraft, which comes in as an expensive way of borrowing. Of course, we might be keeping that to roll over various loans or maybe for working capital. But with this rating upgrade, would we want to retire some of this cash credit overdraft and then in lieu of that have more of CPs and NCDs, more of money market instruments than cash credit?
So practically, if I share with you, cash credit for us is proving to be the most cost-effective borrowing as of now, because with the latest or guideline before few years where cash credit has to be hived off into 60% WCDL limit, which are rolled over every 90 days to 120 days depending upon our relationship with the bank. And we get the rates depending upon the rollover tenure, that is 90 to 120 days. So in fact, the majority of our cash credit, what we use is in terms of WCDL, which is rolled over every 90 to 120 days without putting any stress on ALM, because that is a carve-out of our main cash credit. Having said that, the other thing why over a period of time cash credit will remain constant is because of the fact that RBI and banks are of the opinion that NBFC should borrow less in terms of cash credit. But in our case, even if we take cash credit at only as a 1 year, 10-year loan, we don't create any negative ALM. So we will be in a position to maintain or in terms of percentage reduce this cash credit over an overall AUM. Because if you see this 1700 crores is constant since last 2-3 years, that is reducing the percentage of cash credit to overall borrowing. But that is because of the reason that it is more of a mandate that cash credit should be limited to a certain portion so as not to create ALM, but not from the point of view of borrowing disadvantage. On the contrary, we have two advantages that in cash credit being a floating limit, I can park my excess fund anytime in the cash credit account and use it. So I don't have any negative carry by investing outside the limit. And secondly, as I shared with you, that I get the advantage of rolling over.
Understood, sir. And the new geographies, just last question, sir, the new geographies that we have entered, what products are we doing and what would be our aspiration to do future products which probably have not been added in these new geographies?
We are a multi-product company, and any new geographies which we explore, we see to that how is the potentiality of the various products we operate in. And then with the way we built up our team and the way we have the business plans, few of the products are introduced there. Say, for example, in South we opened Hyderabad with a view to cater to the SME borrowers first, and then we will be introducing other products. Maybe in North also we started with SME product, and now we have slowly introduced commercial vehicle and will be doing two-wheeler also gradually. So whenever we open new geographies, we see to that what is the potentiality of the various products we operate in. And then we start with one or two of the products depending upon the team we build, and then the intention is to introduce all the products gradually.
Understood, sir. I'll come back in the queue, sir. Thank you so much. Best of luck.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity and congratulations for a good set of numbers. So my question was on, given the current environment where, all on the credit side we are seeing good growth and the environment is also pretty buoyant. Do you think, we can strive for higher growth in the AUM by let's say 30-35%, or we will continue to focus on 20-25% kind of growth over the next year or two?
So as I told you, a 10-year is a medium-term view, and just to share with you, to do a 30-35% growth, there are so many enabling situations from the point of view of market size and macro headwinds from time to time. But being in the industry for more than 28 years now, I personally believe that even growing at around 20 to 25% is doubling your AUM every 3.5 to 4 years. and that is a tall order in a lending business if you want to prioritize quality and profitability both. And with companies like us who use a self-propelling capital requirement model, I think this is an ideal mix for us, irrespective of the positive about the positive environment. So what we have done over all these years is that we have not got overexcited by the headwinds, nor have we bogged down substantially when there are challenges. So a 20-25% growth augurs well for a company, in my view, especially in the lending space. And that also is a tall order and a very different growth you get by doubling your AUM and net worth every 3 to 4 years.
True. And sir, on the rating upgrade, given the rating has now been upgraded to AA category, so what on the liability mix side, how do you see this shifting over the next 2 years? Currently the term loan is around 54%, cash rate is around 10%. So how do and the direct assignment and the rest of the things? So how do you see these things shifting over the next year or two? What ideal mix would you like to have on the liability profile, and how is that expected to impact our cost of borrowing over the next year or two?
I think with rating upgrade, the major advantage will be in terms of touching the capital market. So our borrowing from capital market from currently around 10 to 12% should settle between 15 to 20% in next 2 to 3 years, depending upon the overall environment and the competitive rates we get. And plus adding on other institutes where we now start qualifying, financial institutes, now we start qualifying for getting credits from them. So in short, the idea will be to be less dependent on banks, increase our capital market exposure, try and explore other financial institutes who can now take exposures with given our credit upgrade, accompanied by the reduction in rates. So very difficult to predict the exact configuration, but this is the line this is the direction in which we'll be moving.
Sure. And on the bank loan side, given our rating upgrade, how much reduction in our interest cost do you see, on term loans and cash rate whenever they come for renewable over the year?
So as for our back loan is linked to 1 year MCLR, and the spread or the renewal happens once in a year, or where we ask for a fresh enhancement from them. So we see that the impact of the cost of borrowing reduction coming in next 3 to 6 months, depending on the impact of MCLR on the cost of fund of banks.
By how much do you expect?
So we expect our spread to be reduced between 15 basis points to 25 basis points in a 3 to 6 month period.
Sure. Okay. Thank you, and wish you all the best.
Thank you.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Good afternoon. Congratulations for strong numbers, and thank you for giving me this opportunity. So the first question is on the branch addition plan that we have and the targeted market and geography for FY25. Second question is on if you can share separately the DPD buckets of salaried PL as well as in CV, the CV book that we have.
Hi, Dhuvanil on this side. So if we talk about the geographical plan, so as we have communicated earlier that we are pretty strong on the western side with almost 60 branches in Gujarat and 40 each in MP, Rajasthan, and around 30 branches in Maharashtra. So we'll be penetrating deeper into Maharashtra, Rajasthan, MP, number one. And number two, that we are planning, we have already started putting up our feet on the ground in north and south. So we expect that the incremental 20-30 branches that we are planning to add within next 6 to 9 months, I think around 40-45% of them will be from the north and south. So in south, Telangana, Karnataka, Tamil Nadu, these are the three states we are focusing upon, and in north, Delhi NCR and geographies above that. So going forward, I think incrementally you can expect on west, MP, Rajasthan, Maharashtra, and on south, three states, and north, one or two states.
Got it. And on the DPD buckets in salaried PL and CV book?
So, salaried PL is around 3.38 stage 3, 92% is stage 1. And CV, you asked for, no? CV is 4.12% stage 3 and 91% current portfolio, stage 1 portfolio.
Okay. Sure. And if you can just lastly, even on the yields, if you can just, separate yields for CV book and salary PLP.
The SPL yield is around 21%, and SRTO is also ranging from 19 to 21%.
Great. Thank you so much. Best of luck.
Thank you. The next question is from Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir, and congratulations on a good set of numbers. Sir, on the housing finance side, we have seen a strong growth, but at the same time, I think the NPA numbers have been going up steadily as well. So, how do we see this sort of phenomenon to get normalized, and at what levels we should sort of see stable in the numbers in stage 3?
On a smaller portfolio and a less seasoned portfolio, we were around 0.5%, and right now we are at around 0.6%. I think in the long run, we will see net stage 3 assets as a portfolio seasoned, and especially in the borrowers whom we are serving, that is in the affordable space. We will see this housing finance NPAs to settle anywhere between 0.8 to 1.2% going forward. And that will be in sync with our expectation on this type of borrower. And just to add to that in NPAs that does not necessarily mean credit loss as far as the housing is concerned, because we operate at a very conservative LTV. So ultimately, our credit cost will be at sub 1% level in our housing finance company.
And in this sort of a low ticket lending in the affordable segment, while there is a security, but in terms of the capability to possess it back and sort of sell to recover your loan, is that on a practical basis? How does that work, and do you see any sort of a challenges on that front?
So there are two aspects to it. We don't work on any compromised titles. So the titles in our case are very clear. That is what I was sharing, that we took some time to develop our housing finance business because we wanted to understand the title dynamics in each of the geographies we operate in. So given that fact, the propensity to sell the property fast increases. But having said that, we never finance any of the properties with a view that we can repossess and sell it. So at the first instance, the credit is quite conservative. Second is once we repossess it with clear title, it might take time, but we are in a position to sell it depending upon the geographies we work in. But quite sellable.
Okay. And on this, the expansion of the branches, so almost 40-45% was coming from your non-core sort of an area. Now, increasingly, as the economy is getting bigger every year because of the growth and everything. West itself seems to be a large enough market for you at your size to be able to generate that 20-25% growth. So, what is leading us to sort of grow more in geographies? Is the current core geographies of, let's say, Maharashtra, Gujarat, is that not enough to satisfy, additional 1,000 crore, 1,500 crore that we need, 2,000 odd crore that we need for growth?
Hi, Dhwanil again here. As you said, yes, I think West has good potential. I think we are working in good states in West, lucky to be present here. The strategy in expanding in North and South is planning for the next 3 to 4 years. So we take our own sweet time in terms of developing the geographies and penetrating them more deeper in terms of tier 2, tier 3 cities. We take our time. If you look at our progression in, say, MP Rajasthan 3 years ago versus now, you will see that majority of the branches, 3 to 4 years ago, majority of the branches, almost say around 50% of the branches would have opened up in last 2 to 3 years. But we were present in MP Rajasthan, since more than 5 years now. So this is preparation for next 3 to 4 years, and we think that having a good diversified geographical mix also will help us going from 10,000 to 20,000 crores and trying to understand the demography, customer profile, business segments. So just readying ourselves for the future, and that is the reason that we are trying to penetrate and expand more into unknown territories, potentially unknown territories for us where we have not operated earlier.
Okay. On the rating upgrade, this 15-20 basis point that we may gain in terms of our cost of funds, my assumption is that you will be passing it on, right? So keeping your ROA guidance broadly in the same area. Is that true, or is it going to be appropriated by us? So how should we look at your 2.75 to 3.25 ROA guidance? Will that see an upward revision with each rating upgrade, because we are going to gain size with every few years, and that can also lead to some more rating upgrades a few years down the line?
I think when I talk about 2.75 to 3% ROA, all this thing is built in. So when we forecast the 2.75 at a particular phase, and then we talk about 3% aspirational, the range bound ROA, we built in all these aspects that the rating upgrade will happen, economies of scale will kick in, the direct distribution can add on to few more percentage, few basis point more in terms of ROA. So you are right in your assumption that we'll be concentrating our position between 2.75 to 3% ROA with rating upgrade.
Okay. And finally, right now we are at a 4 times debt to equity broadly. While we may not have an immediate need of raising funds, but given that our core engine is churning out 16% ROE plus there is some dividend, and then we aspire for maybe around closer to 25% growth. So to what leverage are we comfortable at a console level? So this 4 can max move out to what leverage level, and hence, by when we necessarily will need to raise funds? What will be the timeline?
So in terms of leverage, we will be comfortable at around between 4 to 4.5 or 4.6 in our parent company, which is well accepted given our track record in the market. And in the housing finance, it will be anywhere between 4.5 to 5%. And on the capital requirement, it was 16%, close to 16% ROE is de-risking at around between 20 to 25% to assignment, 5% to co-lending and all. I think a growth of around 20 to 25%, take a mean of around 22.5%, will be a self-propelling growth. But having said that, as I shared, we already have an enabling resolution, and given an opportunity in terms of valuation and the right set of investors, we might infuse capital to further consolidate the balance sheet.
Understood, sir. Thank you and all the best.
Thank you.
Thank you. Participants who wish to ask questions may press star and 1. The next question is from Hardik Doshi from White Whale Partners. Please go ahead.
Okay.
Hardik Doshi from White Whale, you may go ahead with the question.
Yeah, just a quick follow-up, to the previous question on geographical expansion, where you mentioned you want to get into new areas because it takes a long time to understand the market. Similarly, are you looking at maybe entering any other newer products and trying them out, or these are the products that you're going to stick to for, let's say, the next 3 to 5 years?
So as we have communicated earlier, I think a carve-out from our current lease portfolio will be the used car division. So used car is something that we are piloting with right now. And I think within next 3-4 quarters, it should start taking up shape, and that will be one more product which gets added to our wheels portfolio. We have already started deploying some team piloting, and we are trying to understand the market, and slowly and gradually we'll scale it up once we have the confidence and the full understanding. And as a subset of our SME business, we can call it a sub-product. It will fall under the SME bracket, is the supply chain finance. So that is also a very good opportunity which we are seeing both in our existing customers and acquisition of new customers as well. So supply chain as a subset, but it will get combined with our SME piece only. But those are the two pieces which we are working upon right now.
Got it. And, maybe if from a geographic perspective, let's say 3 to 5 years out, how big do you see the north and south as a percentage of our loan book?
I think in the next 2 to 3 years, I think it should contribute meaningfully at anywhere between 25 to 30%. That is what we anticipate within next 2 to 3 years.
And this would mainly be our Rajasthan MP because that's where we entered first, or you're talking outside of that?
I'm talking about south. I'm talking about south and north. So 20 to 30% is the new geographies that we are currently working. That will contribute around 20 to 30% in terms of the overall even in next 2 to 3 years. West, I think Gujarat will lead the pack with around 40%. And Maharashtra, MP, Rajasthan will be equally divided at around 10 to 12% each.
Okay, so then that's a pretty meaningful growth in 3 years if you want to get to that level for just north and south, which is outside of our core, which is Gujarat, Rajasthan, and Madhya Pradesh and Maharashtra, right?
Yes, so I think that is why we are setting up early, getting our feet on the ground there, and we anticipate that the markets are good from our limited experience and from the peer reviews that we have done. I think the markets are huge for the products that we are operating in. So we can't ignore those markets, and I think if our retail distribution keeps on growing at the pace which it is growing at right now, I think that number is achievable.
Yes, but just asking the question which the previous participant asked in this context, right? Are you hitting any kind of constraints of growth in Gujarat, Maharashtra? Because our size, at 10,000 crore is nothing compared to the products that we are in, right? So, again, why not, the geographies, there's a very large market, addressable market. Why go into newer areas when there is so much room in our existing areas?
So, as you rightly said, there is good opportunity in the West, and that is why our expansion in the West is also happening at a good pace. So, as I had earlier mentioned, the number of branches that we opened up in western states other than Gujarat, the number has gone up sizably in the last 2 to 3 years. So, we are not facing any constraint per se, but we are anticipating that geographical diversification will be good, and getting ready for it early will be helpful rather than say at say 2 years down the line increasing the portfolio very rapidly in other states is something which has not been our way of working. So we feel that going a little early, and if you would have noticed that we had very minor presence in South around since 5-6 years now, but we were not growing it. So now we see that the opportunity is good, diversification of portfolio, and also increasing these western parts meaningfully in the next 2 to 3 years. We feel that this is a good strategy. But per se, if you talk about constraints, we are not seeing any major constraints in terms of growth. The major contribution still for this year and next year will be from the western part.
Okay, got it. Thank you.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to the management team for closing comments.
So thank you everyone, and as shared by me and the team, that we are very confident going forward, and in consistent to our belief of consistent to our belief of growing fundamentally, we'll continue to work on the same line, and we'll be in touch. Thank you.
Thank you very much. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.